Welcome, everyone. If you're tuning in, you probably already get that in the financial markets, not every investor is looking to aggressively chase high-risk equities. Sometimes, actually, scratch that, most of the time, the absolutely most sophisticated thing you can do is just protect what you've already built. Sure, conservative funds might have a reputation for being, well, a bit boring. But today, we're undertaking a diploma-level explainer on conservative mutual fund products. We're going to look way past the basic definitions and deeply analyze the mechanics of capital preservation, risk mitigation, and predictable income. So grab your notes, get focused, and let's master the art of financial defense.
Okay, here's our syllabus for today. We'll start with the foundations of conservative investing, then move into the 4 types of conservative funds. Third, we'll look at understanding the hidden risks, because, let's face it, low risk doesn't mean zero risk. Fourth, we'll cover tax implications in portfolio strategy, and finally, we'll wrap up with a real-world Canadian business application. Let's get to it.
Section 1. Foundations of Conservative Investing. Let's lay down the groundwork. So, by textbook definition, conservative mutual funds are professionally managed investment portfolios that primarily target low-risk financial instruments. We're talking about things like government securities, investment-grade corporate bonds, and short-term debt. Now, the core objective here, it's strictly about capital preservation and generating a modest income. The goal is steady, low-stress, reliable income. We are absolutely, aggressively avoiding those stomach-churning market fluctuations.
To make all these academic concepts a bit more tangible, we're going to use a running case study throughout this explainer. I'd like you to meet Sarah. She runs a highly successful landscaping business right here in Canada. And, like a lot of business owners, she deals with incredibly seasonal cash flow. She's got money just sitting idle in the winter. She needs to save up for a pretty costly new commercial mower in about 3 years. And above all else, she absolutely needs to protect her hard-earned capital. Let's see how these funds can actually work for her.
Now, the whole philosophy behind these funds really rests on 3 core principles. Step 1 is safety first. Managers strictly select high-quality, low-default risk securities because protecting that original investment is literally paramount. This directly aligns with Sarah's need to make sure her business capital doesn't just vanish in a market downturn, right? Step 2 is income stability, which means providing consistent streams of cash through interest and dividends. And finally, Step 3 is controlled growth. This is where a tiny, limited amount of equity exposure might be used just to slightly enhance those returns without breaking that golden safety rule.
Moving right along to Section 2, 4 types of conservative funds. Now that we've got the philosophy down, let's look at the actual products.
First up on the list, we have money market funds. These invest in short-term debt instruments that mature in less than 1 year. We're looking at government treasury bills, corporate commercial paper, bankers' acceptances used in trade financing, and certificates of deposit. The absolute key takeaways here: extremely low risk and high liquidity. For our business owner, Sarah, this is exactly where she'd want to park her idle seasonal cash during those slow winter months. It essentially acts as a highly liquid emergency fund she can tap into instantly with zero worries about sudden market dips.
Next, we've got bond funds, which invest in longer-term government, corporate, or municipal debt. This one brilliantly illustrates the classic risk-reward trade-off of duration. Notice the contrast here? Short-term bond funds have lower interest rate risk and incredibly stable prices. On the flip side, long-term bond funds offer higher potential returns, sure, but they come with a much greater sensitivity to interest rate changes. Think about Sarah. If she needs to buy that massive commercial mower in exactly 3 years, a short-term bond fund is honestly her ideal vehicle. It gives her a better yield than the money market, but matures right when she actually needs to write the check.
Third, let's talk about conservative balanced funds. If you take a look at the chart on your screen, you can see a typical allocation, usually sitting at roughly 70 to 80% in bonds and maybe 20 to 30% in equities. This setup acts as a fantastic strategic middle ground. That massive bond portion generates steady income and really suppresses the overall volatility. Meanwhile, that small slice of equities, it offers just enough growth potential to help stave off inflation. It's basically built for the investor who prioritizes safety but still wants, a little bit of engine power in their portfolio. And finally, the 4th type, guaranteed investment funds. Here in Canada, you'll widely hear these referred to as segregated funds. Now, these are insurance-based products. They literally guarantee 75 to 100% of your principal at maturity or death, no matter how terribly the underlying market performs. But here's the real kicker, the absolutely crucial advantage for a small business owner like Sarah: creditor protection. The fact that these assets can often be completely shielded from business creditors is just a massive structural advantage. Yes, you are going to pay higher management fees for those insurance wrappers, but for estate planning and asset protection, they are incredibly powerful tools.
Section 3. Understanding the hidden risks. Because conservative definitely does not mean risk-free. Let's analyze the downside.
The most fundamental danger in fixed income investing is interest rate risk. I want you to picture a seesaw in your mind. When central banks cause interest rates to rise, the value of existing bond prices falls. Conversely, when interest rates fall, existing bond prices rise. It's an inescapable mathematical inverse relationship. If you're holding a long-term bond fund and rates suddenly spike, the market value of your portfolio is going to drop. Simple as that.
But wait, there are 3 other hidden risks we absolutely must account for. First up is credit risk. That's just the possibility that the corporation or municipality issuing the bond simply defaults and can't pay you back. Second is inflation risk. Think about it. If a conservative fund yields 3%, but inflation is running hot at 5%, your real purchasing power is actually shrinking. For Sarah, this means the real-world cost of her landscaping equipment is growing faster than her savings are. And finally, reinvestment risk. If interest rates drop, the income your fund generates has to be reinvested into the market at those new, lower rates, which basically drags down your future yield.
All right, Section 4, Tax Implications and Portfolio Strategy. Let's look at the math and see how these funds fit into a broader master plan.
Looking at the risk and return matrix here, you can clearly see exactly where conservative funds sit relative to balanced and equity funds. They offer low risk, low return, and low volatility since they're focused almost entirely on bonds and cash. In a well-diversified portfolio, a highly risk-averse investor or perhaps a retiree might allocate 60 to 80% of their total wealth right here in this conservative column. It perfectly balances out the higher volatility of their equity holdings.
But here's the thing, where you hold these funds mathematically dictates your overall success. Let's talk taxation. In Canada, if you hold a bond fund in a non-registered account, the interest income it generates is fully 100% taxable at your marginal rate. And honestly, that is highly inefficient. Because of this, conservative funds are often best sheltered inside an RRSP for tax-deferred growth, or a TFSA, where the interest compounding is completely tax-free. You've really got to optimize the location of the asset, not just the asset itself.
From a macro perspective, the overall strategy here is really all about the business cycle. You see, conservative funds absolutely thrive during economic uncertainty because of their rock-solid stability. However, and this goes right back to our seesaw analogy, they will mathematically lag during periods of high inflation, and their capital value is going to temporarily decline when central banks start aggressively raising interest rates. Section 5, Real-World Canadian Business Application. Okay, time to step out of the textbook and put this theory into concrete numbers. Let's crunch the actual math here. If an investor places $20,000 into a highly rated conservative bond fund that yields, say, a 4% average return, it generates exactly $800 in annual income. Now, I know what you're thinking. $800 might not sound like a lottery win, but remember our core objective. This is steady income with absolutely minimal risk exposure. Your $20,000 principal remains largely protected and completely intact, quietly doing its job in the background without causing you a single sleepless night. So let's look at how Sarah, our landscaping business owner, brilliantly deployed these products to build her own custom financial shield. She takes her idle winter cash and parks it in highly liquid money market funds. For the $20,000 commercial mower she needs in 3 years, she utilizes short-term bond funds to earn that reliable 4% while effectively mitigating interest rate risk. And for her long-term wealth, she utilizes segregated funds, gladly accepting slightly higher fees in exchange for ironclad creditor protection for both her business and her estate.
By treating conservative mutual funds not as boring alternatives to stocks, but as highly specific, protective tools, you can build a financial foundation that simply does not crack under pressure. So I'll leave you with this one question. Is your portfolio structurally sound enough to weather the next economic storm? Thank you all so much for watching this explainer. I really hope it brought you tremendous clarity. If you found this valuable, please like the explainer and subscribe to the channel so we can keep bringing you these focused, deep dive analyses. See you next time.